Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, August 11th, and I'm recording this from our studio in Purchase, New York. In just 4 months, there's been a staggering reversal in U.S. equity market sentiment, from uncertainty and fear to euphoria, and in the economic outlooks, from recession to a disinflationary capital spending boom. This has supported a historic run, with the S&P 500 up 29% since April 8th. We understand the thinking behind the bull case, namely that tariffs will prove navigatable and non-inflationary, that growth in generative AI combined with a CapEx boom spurred by the One Big Beautiful Bill Act will improve margins and productivity, and that the weak U.S. dollar will flatter exporters. However, we see a data mosaic that includes more mixed signals and at least 3 risks that the markets may not be properly discounting. First is the labor market. The latest non-farm payroll numbers were eye-popping, not only for missing the consensus estimate, but also for the significant downward revisions to the previous 2 months. The 3-month average job creation now stands at a meager 35,000. Well below the previous trend of 150,000. There is more data that substantiates this trend. For example, continuing unemployment claims are up significantly since April. The JOLTS report suggests that the lowest hiring rate since 2020, and a Conference Board survey indicates that finding a job is now as difficult as it was in 2021. Labor markets are clearly slowing. A second area where investors may be wearing rose-colored glasses is how they're interpreting second quarter earnings. Yes, the earnings beat rate is once again at 80%, and the earnings revision breadth is now positive. And year-over-year earnings growth is currently pacing at more than 9%. Beneath the surface, though, there are material sectoral skews, and the ongoing dominance of the Magnificent Seven is glaring. Of the 11 major sectors, only 3, infotech, communication services, and financials, have posted double-digit gains. And while the Magnificent Seven are growing their earnings at a 26% annual clip, the remaining 493 companies in the S&P 500 are barely up. A final area where there is a clear desire to ignore the data is around inflation and tariffs. Granted, we have not yet seen the imposition of 10% universal tariffs flow through to reported inflation. We would suggest that this is a case of pain delayed, not necessarily denied, especially as the most recent announcements nearly double the effective tariff rate to up to 18%. Inflation has already been grinding higher, with the core CPI reading at 2.9%. And one of the most accurate forecasting measures, the 1-year forward inflation swap, is back to where it was during the post-Liberation Day bear market scare at 3.3%. Investors appear complacent as the bull run continues. We fear they have missed the potential implications of the latest data amid the steady stream of policy announcements. As risk managers, we want to avoid the shoulder shrug of Alfred E. Neumann, and instead choose to hedge when the data is mixed. Investors should consider adding real assets like gold, REITs, energy infrastructure, industrials, and ag commodities, and taking an active stock selection approach to U.S. large-cap quality names. Intermediate duration investment-grade fixed income, including municipals, and international equities, including emerging markets, as well as hedge funds and private secondaries, round out our key recommendations. Thanks for listening, and for more information on portfolio strategies and financial planning, please, as always, reach out to your Morgan Stanley financial advisor.